A very good evening to everyone. Today we have gathered to talk about the various liquidity deposit solutions for our audience. So, traditionally, whenever we speak about mutual funds, the first word that comes to our mind is equity. However, today we have a host of options and fixed income funds as well in the market that act as great tools for cash management as well as liquidity deposit. But what exactly are these funds? Are they, or how safe are they to invest? Are they, how different are they from traditional saving options? What is the tax efficiency? Or how long should one stay invested in these funds? I'm sure our audience has many of these questions on their minds already. And to answer them all, we have with us today Mr. Aditya Pagaria. So, Aditya is a senior fund manager of the fixed income investment team at Axis Mutual Fund. He has been associated with Axis since 2016 and is managing some of the key debt funds. So over to you, Aditya.
Thank you so much, Tanvi, for setting up this webinar on cash and deposit management. If you can just share the PPT, thank you so much. So, welcome everyone. Good evening on a Friday evening. Just welcome to you on a small webinar wherein we have host of liquidity and deposit solutions in mutual funds. So we'll just take you through how you can manage your money better, how can your money earn much more than lying into your saving bank account or any other traditional products like a bank FD or a current account or a savings account. So we'll just take you across a small presentation. First of all, I'll just brief you on what has been happening globally on a macro perspective. Just a small bit of update. Just to give you a background, since April 2022, we have seen all the globally central banks hiking rates, even followed by India. So we were at a repo rate of 4% in April 2022. Now, it's been 1.5 years. The rates are closer to 6.75 now. So we have seen a rate hikes of closer to 250, 300 basis points. The liquidity that was there in the market, that will be sucked up entirely by the RBI, the central bank, thereby supporting. The rates were 2 years down the line when you used to see what are the investment option available in debt mutual fund side, and when people used to see the YTM, so they were closer to 4%, 4.5%, 5%, depending on the product that you choose. In today's scenario, post 200, 250 basis point hike, and the liquidity that is being sucked out by the central bank, the liquidity that was, just to give you a few numbers, the liquidity was surplus of close to 10 lakh crores in the system. Now that liquidity is closer to zero. So almost 10 lakh crores of liquidity has been sucked out from the banking system by the central banks. And obviously, in any type of rate hiking scenario, what any central bank does globally is, along with the rate hikes, they have to pull out the liquidity, because easy liquidity and rate hikes don't give the exact exact hit that the governor or the any central bank has to give it to the economy. So they go in tandem. Basically, you keep on increasing the rates and you keep on sucking out liquidity from the market. So as I said, from 10 lakh crores surplus liquidity to we are almost close to zero now, and that's a very beautiful time for the investors who, people used to see a YTMs of 4.5% 1 year down the line, 1 year hence. Now they are seeing YTMs closer to 7.5, 7.75. So that's a beautiful time for any investor to put their surplus money in these kind of products. I'll just take you through what are the fund categories, broad categories that SEBI has defined for debt mutual funds. Tanvi, next slide, please. So broadly, if you see an overview, the least duration or the safest asset safest fund category is overnight funds, followed by the liquid funds, the ultra short-term category, the low duration. These are money market categories, as we say in our parlance. The medium duration and the long duration funds are something where the duration comes into play. It's more of a duration play rather than a liquidity play. So what we are going to cover in today's presentation is broadly the middle of the pack, the two schemes, that is ultra short term and low duration. That includes the money market funds. So just to give you background, basically what happens in these kind of products, it helps your idle cash to work better for you. It gives you, imagine your money lying in your bank account. What bank account gives a saving account rate is not more than 3.5-4% for any banks, or maybe in an FD. Again, the returns are not that great, closer to 7%, not more than that. So what happens is, by investing in money market schemes where you have a time horizon of, depending on your time horizon, 3 to 6 months or 6 months to 1 year. So it gives you a better return on your products. It gives you liquidity. Anytime you need the money, you have, as a debt mutual fund, you are free to move your money anytime. So you deposit the money today in any of these funds, you need the money, 1 week down the line. So you can just redeem the money and you get the money the next working day. So the liquidity is not a stress anymore. So your money works better, it works harder, plus it gives you a better liquidity. And obviously you can plan your future payments. For example, you have a certain liability that you have to pay off, say in a month or in a couple of months down the line, and you don't know what to do with this kind of money lying in your bank account. So that's a better way to deploy the money in these ultra short term money market or a low duration kind of product, so that you get a better return on your the idle cash that you will have. Next, Tanvi. So these are the broad two categories that we will be discussing today: the ultra short term and the money market funds. So broadly, these are both are open-ended funds. So ultra short term, what the SEBI has mandated, it's more of a fund where it invests with a time horizon of wherever the investor has a time horizon of 3 to 6 months. It matches with the fund mandate. That also the maturity, that the average maturity, what ultra short term runs is roughly around 90 to 180 days. That is 3 to 6 months. That is exactly matching with the time horizon that investors want to invest into. The money market funds, the other category, again, it is flexible. The tenure can range from as low as 1 month, depending on the market scenario, to 1 year, maturity. So it will be a mix of CPs, that is commercial papers, or certificate deposits. We lend to marquee names in terms of NBFCs, manufacturing names. So all kind of, we have exposure to T-bills, government, GSEC. So these kind of names, or these kind of, you have a well diversified portfolio with no entry and no exit load. Again, as I said, redemption payout is T+1. So anytime you need the money, you just redeem the money. You will have the money in your bank account the very next day. So again, depending on time horizon, anything between 3 months to 1 year, these are the best products to invest in right now. They are easily beating the traditional deposit options that you have, like current account, savings account, or bank FD. These are handsomely, the kind of returns that they have been giving, or the portfolio carry that they are having right now. Just to give you an example, the entire curve from, say, 3 month to a 3 year assets, the entire curve in the money market space is totally flat. So roughly, just to give you a background, if CDs are trading closer to 7.5, 775, and the CPs in the market are trading closer to 7.75, 8%. So you get a blended yield closer to 7.5, 7.75 for these kind of products. So for as you compare it with a traditional deposit, it's a no-brainer for any investor to park their surplus money in these kind of fund categories. Uh, we actually get to hear from many uh, investors, why should we invest in money market funds when there are options? There are some banks who are getting or giving us rate something like 6.5-7% also. So just to give you a background, these are lower rated banks. uh, they would be having a kind of uh, laddering of the amount. I mean, if you put 1 lakh, you will get 5% interest. If you put 10 lakhs, you will get 7% rate of interest. So these kind of laddering is there. So what happens in a mutual fund? So it is very clear. You put 50,000 rupees, or you put 5 lakh rupees, or you get 5 crore. You put 5 crore rupees. Whatever return that 5 crore guy will make, even the 5,000 guy, 50,000 guy, the same returns is made by all the type of investors. So there is no differentiation between bank deposit of 1 lakh rupees or 5 lakh rupees or 10 lakh rupees as compared to a mutual fund scheme. The entire uh, the entire set of investors get the same return. So that's a very big benefit for any investors to get in these kind of mutual fund scheme for parking solutions. Next, please, Tanvi.
Aditya, if I may just interrupt you here,
Sure.
you spoke about average maturity of the funds. So,
Yes.
just for the help of our audience, could you just explain in brief what exactly do you mean by that? What
The
is
average maturity, sure. Thanks, Tanvi. See, average maturity of a fund means what is the basically it is sum of average of whatever investment I have made in a security. In the securities, the overall uh, duration. So, for example, I'll just give you an example. If I have 100 rupees in my portfolio, if I invest, if I keep 50% of money in, say, a one-day security, and the rest 50% of the money I invest in a 365-day asset, the average of the two securities in my portfolio comes to 6 months. That is 0 plus 365 divided by 2. So average maturity of the portfolio becomes 6 months. So this average can be in many ways. For example, I just to give you a very clear, simple example, 50% of the money I invest in 3-month asset, and 50% of the money I keep in a 9-month asset. So average maturity of the fund will come to closer to 6 months. So average of the whatever investment I have made, the average duration of the money market instruments what are invested is closer to 6 months. That is what you mean with the average maturity of the particular fund.
Okay, I'll just quickly ask another question here, which might be helpful to the audience.
Yeah.
That we have written here, mentioned that the ideal investment horizon is, say, 3 to 6 months, and for money markets, 3 months to 1 year.
Yeah.
So since most of audience might be investing in instruments which are for a fixed period, say 200 days or 150 days. So what exactly would happen in a debt fund if his investment goes beyond these 6 months, or if he decides to stay invested for more than a year or a 2? What exactly, or how does it affect his investment return?
See, the best part is that unlike in traditional deposits, whenever if you have put in a 6-month traditional deposit, the money will come mature and will come to your bank account. The beauty of ultra short term or money or any other open-ended mutual fund, these are actively managed funds. So what happens is, depending on market scenario, we keep on churning the portfolio. Depending on the market scenario, we keep on changing the average maturity to get the best deliver the best returns to the investors. So in that scenario, even if the investor comes with a 3-month, 6-month type of a horizon, and if his liabilities are postponed for, say, another 6 months, he can stay invested in these funds without worrying about the any kind of redemption coming to his bank account, and then again he keeps on scouting for alternate solutions for investment. So till his the solution, for example, for whatever he wants to achieve, his liability, if it is postponed in the future, that's the best part, that he can stay invested for 3 months, 6 months, 1 year, no problem. Even if the liability is postponed, he can stay invested, and he will continue to earn the same returns that he has. I mean, market-linked returns, obviously, as he will earn in for if he stays for 3 months or 6 months. So that is not a problem. So it's continuity. You can stay invested in these funds, and the best part is it is actively management. So the fund manager will take active calls to get the best alpha that is required to give the best returns to the investors. So who can invest in this fund? So these funds can be invested by basically it is anyone, be it corporates, be it individual investors, banks, financial institutions, insurance companies. So, I mean, these are the funds that anyone can invest. As an individual investors, you can start with as small amount as 1,000 rupees, 5,000 rupees. Doesn't matter. The upside is open. For domestic corporates, what happens is instead of money, even if they have surplus cash for few times, they normally the money is parked in current account. They don't earn any kind of interest. So what happens is we see decent amount of flows coming in these actively managed money market funds, wherein the domestic corporates enjoy a healthy return as compared to alternate traditional investments. Banks and financial institutions, as I said, when there is surplus liquidity in the market, the rates are much lower. In that scenario, the banks and the financial institution also look out for alternate, avenues for investment. So these are the banks and investments. They also can come and invest in any of these money market funds. Individual investors, obviously, as it is clearly written that they provide better returns, risk-adjusted returns, as compared to a traditional investment options that you have. And one big benefit that past couple of years, past many years actually, we have seen, they can use these funds as a parking solution for doing STPs in any of the equity funds. So if you have, for example, if you have done an SIP in any of the equity fund, instead of the money lying in your bank account, it's better to park this money, get better returns in debt than the traditional bank account. And you keep on doing, instead of an SIP, you do an STP. So what happens is the systematic transfer plan from every month on the defined date, your money will switch from these money market schemes to any of the equity schemes or hybrid schemes of your choice. So this is the best part that you have. Instead of the money lying in a bank account, you keep money invested in these ultra short-term money market funds, and automatically with the market returns, those are better than your traditional bank deposits. You get better returns in debt also, and then you can switch it to equity funds as in form of STPs. And similar applies to insurance companies. Basically, there is a host of investors who are covered. As I said, the amount might range from as low as 1,000 rupees to crores of rupees, whatever the investors want to invest into. This is a very important slide, actually. Actually, we get many questions on why to invest in debt mutual funds. I have many other traditional investment options. So why don't I go with those kind of products? And why do I stick with mutual funds? So most of it I have covered. Just to glance you through. So what we follow is, in any debt mutual fund, what as a practice in Axis Mutual Fund, what we follow is the rule of SLR, that is safety first, liquidity, and then the returns. So what happens in terms of liquidity, debt mutual funds, as I say, whenever there is a need, because this is a surplus money that you have lying in your bank account. So anytime you need money, you put the redemption today, you get the money in your bank account tomorrow. You can use the money for any of the liability that you want to pay off. So that's the best part. The liquidity is there. There is, except I guess the liquid fund where there is graded amount of exit loads. These kind of money, ultra low duration fund, they don't have any kind of entry or exit loads. So anytime you can get in, anytime you can get out. That is not the case in case of traditional deposits. For example, just to give an example, if you go do a traditional bank deposit FD, if you do a example 5 lakh rupees of FD and you need a part amount to be redeemed, because you have a liability of say 2.5 lakh coming up. So what you have an option to do is break the entire FD. So it comes out that you have to pay tax on the entire amount of 5 lakh interest that you earned the income. 2.5 lakhs you have to pay a liability, then you have left again with the amount of 2.5 lakhs to deploy the money at. So what do you do with that? So the best part is, in debt mutual funds, you invest 5 lakh rupees, whatever amount you need to redeem, be it 10,000, 5,000, 2.5 lakhs, entire 5 lakh, you can redeem partial without any kind of exit loads. Again, the flexibility. When it comes to flexibility, as I said, one option that debt mutual fund provide is better return. You can do STPs through a mutual fund. That gives you better, the debt portion of it gives you a better return in any of the equity schemes, or any kind of hybrid schemes that traditional instruments don't give. Individual bonds, obviously, they don't have the flexibility, in the sense the time horizon. For example, it is very difficult to match the individual bonds flexibility. For example, you have a liability to pay 4 months hence, but if you are getting an individual bond, a 3-month bond, so again there is an asset liability mismatch. So in that case, individual bonds don't provide that flexibility, but a debt mutual fund does provide that flexibility. Diversification, a very important part. Diversification, as against I said, instead of parking the money in a traditional investment option, you are exposed to one single bank or one single instrument. In a debt mutual fund, what happens? It's a mix of, as I told you earlier, certificate of deposits, you have commercial papers, you have T-bills, you have government securities, and among that also we have very huge amount of diversification. For example, I don't invest more than 5-7% in a single issuer. So what happens is, for building 100% of the portfolio, I have 10-20 different type of names, different type of exposure in a particular fund, so that there is diversification. Obviously, if one asset goes, if there is a liquidity stress, I am not able to sell the entire portfolio. There is, the more the diversity of portfolio is, the better the liquidity and better the flexibility of the portfolio is. Again, the professional management, we as the fund managers, obviously, as I told you, every time we want the best returns for the investor. So it's active management. We do study many kind of liquidity analysis. We see what globally what is happening to the currency, what is happening to the global macroeconomic factors. So it helps us taking the decisions. It helps us maximizing the returns in terms of active management of the debt mutual funds. And obviously, these professional kind of management, active management, is not possible in a individual bond or a traditional saving instrument. Obviously, transparency is of utmost important. We, as per our regulator, we are supposed to disclose all our portfolios every fortnight. So whatever money you give to us, whatever investment what we are doing with those money in any of our funds, it is very clearly and transparently disclosed on our website. What is our portfolio composition? What is the percentage? What are kind of AAA exposures or non-AAA exposures? What are the kind of names we are running? What are the type of PSUs, CDs, CPs? Whatever exposure it is very clearly and transparently available in our fact sheets. And obviously, the best and the most important point is tax deferment. So what happens in a tax deferment? Unless if you come and invest in a debt mutual fund, till the time you are invested, you don't have any kind of tax liability. But in case of individual bonds or traditional saving instrument, there is a possibility that in case of traditional saving instrument, that TDS is deducted by the banks or individual investment. Even if there are coupon inflows in between, again there is a probability that TDS might be deducted by the corporate that you invested in the bond. So in case of debt mutual fund, that's the beauty. There is no tax liability unless and until you redeem the money from the fund. So as long as you stay invested in the mutual fund, you need not worry about any of the tax liability. And the best part is the returns that you get. These are market linked returns in debt mutual funds. So what happens is, for example, I'm telling that today we are sitting at 6.5 of operating rate, that a repo rate that is defined by the RBI. What happens if 1 year down the line we see 100-150 basis of rate cuts coming in next 1 year? So obviously, as just to give you the basic example, when the rates go down, the prices of the debt instruments go up. So when we see the rates going down, the value of an investment goes up. That is not a case in case of a traditional FD or any other saving bank account that you have. So it's a fixed kind of return. Even if the rates start to go down, you won't have any kind of mark-to-market gains. But in debt mutual funds, obviously, since the returns are market linked, so whenever there is a rate cut, or even if the market gets a whiff of any rate cut coming in the market, so that kind of market linked returns will be delivered to the investor. So that is the best part, is the market linked returns. It's not a fixed return kind of an investment. Next slide, Tanvi.
Aditya, since we are on the topic of, you said that whenever there is interest rates would be going down, the value of the investments would be going up.
Absolutely.
So just could you just say like maybe 3 or 4 parameters of the economy which the investors can see or should consider while they are doing debt investments? Like for equity, they know most of the audience would be knowing that a large cap fund, what a mid cap fund is, or a small cap funds are probably riskier than large cap funds. So similarly for debt funds, what are the 2 or 3 parameters which audience should look at while investing?
Do you mean to say the economic parameters or
the economic parameters?
So, see, economic parameters, it is very clearly stated by our central bank. Inflation is a very, very important parameter for any central bank globally, as well as our central bank. So that is the most important parameter for understanding the trajectory of how the rates will be in the future. So whenever there isn't, you would have seen historically, we have seen 7-8 just a year back, we have seen an inflation rate of 7 to 8%. That is pretty high as compared to what the RBI's comfort is. RBI is comfortable with 4 to 6% band of inflation. But obviously, when the inflation is 8%, obviously, as globally central banks have done, the same is being done by RBI. They have kept on hiking rates till the inflation comes under control. So those kind of rate hikes are being seen in the economy right now. The inflation has brought under control. Roughly, it has fallen into same 4 to 6% band. So last inflation period was closer to 5%, 5.5%. This month's inflation is expected to be closer to 5%. So inflation is under control. 4 to 6 band is something that central banks, India central bank is very comfortable with. So inflation is very, very important. Inflation is coming under control. The next important part is growth. So our central bank, as compared to other central banks, is a very balanced central bank. So they are very clear. They want inflation as well as growth. These are the two very important parameters for our central bank. So what happens is they don't want to kill growth by keeping on rising the rate, so that the inflation is under control. So they are very clear. I need a balance between what happens to the inflation and what happens to the growth in the economy. So for them, inflation is under control. The growth parameters, what we have been seeing in past 6 months or so, the growth, thankfully, because of the right amount of rate hikes that RBI has delivered, the growth has not been hampered much. In fact, you would have seen a comment by RBI governor a couple of days back that the market will be surprised with the kind of growth that the economy will see in next couple of quarters. So these two are the very important factors as while investing in debt mutual funds, where the inflation trajectory is and how the growth is being. Obviously, there are other factors like the liquidity in the system. How is the liquidity panning out? what other global banks are doing. So obviously there are many other factors actually. So apart from, amongst those factors, inflation and growth are the two main important factors that any central bank sees as prime factors to see the next, the how the interest rate will pan out in the future. We just see the historic performance, how basically the fund that we have discussed, the ultra short term fund or the money market fund. So ultra short term fund, if you see, since broadly June 2022 till date, what the rate that we are seeing 3 months rolling return is easily closer to 7.5-8%. Same is the story with money market fund. Again, the return is average around 7% in past 6 months or so. So broadly, with this tightening liquidity, we expect the rates to remain higher for next 6 months or so. As I said, the RBI, instead of hiking the rates too aggressively, what they have done is they have kept the liquidity tighter. That will help the shorter end of the curve. Basically, shorter end, what we say, up to 1 to 3 year kind of a curve. It will stay elevated for next 6 months or so, and that is the reason, that is the best time for any of the investors to come in these kind of funds, stay invested in these funds, and get a better risk-adjusted returns as compared to traditional investment avenues available in the market. So just a few minutes how to invest in these funds. So basically, you can invest in these funds either directly through the AMC's website or through your basically IFAs that are there in the. There would be any distributors, IFAs, banks that are there in the market. So it is in this kind of digital world, it is very easy to go to our websites, submit an application form via email. There are applicable cutoff time that is very clearly mentioned on the website, as well as our application forms. Again, it can be invested via check, NEFT, RTGS, fund transfer before the cutoff time. So whenever you invest on a particular day, the day ends NAV will be allotted to you, and the units will be allotted to you based on the day that you have invested. So day end NAV will be allotted, and whatever the NAV and the number of units have been allotted, the same will be sent to you via account statement that is generated by the system. So in your personal IDs, in your through WhatsApp, SMS, there are many ways to invest in these funds and get the account statements directly in your email IDs.
Great, thanks, Aditya. So when we
happy to take questions if you have any.
Yes.
Yeah, sure.
There are a couple of questions which people had asked when they registered. So one of the most important questions which comes during all webinars, and I think it's a favorite, is that how does a person, decide how much portion of their entire corpus they should invest in these kind of funds? How does that allocation percentage be decided by the investor?
See, as far as basically this cash management is concerned, as I said, you have to match your liabilities. So if you have a liability, if you have cash surplus right now, and you have a liability to pay off, say 3 months or 6 months down the line, so basically you can allot the entire amount of money in these kind of funds. So because just understand, these are just traditional products. These are just option for better returns as compared to a traditional product. So instead of money lying into your bank account for 3 months, or money lying in your a traditional bank deposit for 3 months, because 3 months or 6 month kind of FD rates are pretty low. And as I have told you, in terms of liquidity, flexibility, and diversification that a a mutual fund provides, that these traditional investment avenues don't provide. So in that case, uh, any money that lies in your current account, savings account, or maybe in a bank FD, that entire amount can be allocated, and with a time horizon of uh, broadly 3 to 6 months, instead of in spite of there are avenues available like liquid fund. For example, liquid fund uh, is more of a product wherein if you have a time horizon up to 1 month or so, you can invest the money in liquid fund. So anytime, what we do as an communicate to investors what is the good time to invest and what is the amount to invest. So good time to invest in these kind of ultra short term money market low duration funds, in where the YTM difference between a liquid fund and these funds is roughly around 30 to 50 basis points. That is the time you can invest in these particular fund categories, and these are absolutely safe products, providing you good liquidity, good flexibility, so that entire amount can be allocated. Not a problem at all. Uh, I mean, as I told you, liquidity can be provided the very next day. So even if you have a 3 month liability, a liability to pay 3 months hence, but you have a liability that suddenly comes up, say 1 month later, so you can immediately withdraw the money and pay off that liability. So in terms of flexibility, in terms of uh, diversification, the entire money, whatever surplus you have that is lying in your traditional deposits, that money entire can be invested in these kind of funds.
Okay, great. So somebody has been asking that what exactly, apart from the duration, a major difference between a liquid fund and a money market fund?
Okay, so I'm sure this audience knows that, for example, liquid fund can invest only in securities up to 91 days, and these funds have the flexibility to invest in, from a 91 days to 365 days type of security. So even beyond that, because my average should come to, depending on the fund mandate, the average portfolio maturity should come to 180 to 365 days. So what happens is, so if you see a typical fixed income curve, it's an upward sloping curve, wherein the lowest maturity uh, security will give you a particular return. Obviously, as you move along the curve up, the returns are much better than those lower maturity securities. So in that case, anyone uh, who want to invest for a longer time horizon, instead of a liquid fund, investing at, for example, I give you just live example. If the liquid fund uh, yields are closer to 7, 7, 10 as of last month end, and if you compare it with these kind of money market products, the yields would be closer to 7.5, 7.75. So these kind of uh, 40 to 50, 60 basis point of uh, difference in yields is very attractive for these kind of funds. So instead of parking money in liquid funds or overnight funds, it is better to be invested in these kind of parking solutions that give you much better risk adjusted returns for a longer time horizon.
Okay. Aditya, the next question is that what is the approximate duration of fixed income securities in your funds, and how do you decide the optimal duration?
See, again, as I said, that what we as a part of our active management, what we do is we study various parameters that affect the economy, that affect what the central bank would think. So it would include how the liquidity is panning out, uh, how the inflation is panning out, how the growth is panning out in the economy. So depending on those factors, we take an active call. We see the security spreads. What are the spreads that, for example, uh, uh, what spreads the corporate bond or a CD is trading over similar kind of a GSEC or a T-bill. So if the spread is attractive, we are more than happy to invest in those kind of securities. If the spread is lower, we are happy to invest in T-bills or GSEC. So these are some of the factors that we see while deciding on how much money to allocate to a particular segment of the curve, how much money do we allocate to a particular issuer, how much money to allocate depending how as a mutual fund my liabilities as a. So even we as a mutual fund managers, we see how our liabilities are, how the inflation pans out, how the spreads are vis-a-vis compared to the similar kind of sovereign assets. So these are the some factors that we take into consideration while building our portfolios. Uh, Again, obviously, that helps us to maximize the return for the investors.
Okay. So the next question being that you spoke about short-term duration funds, but if I want to park my funds for 3 to 4 years, are there options in fixed income funds?
Yeah, 100%. These are, I mean, as I showed you in the first slide, so there are overnight, liquid, ultra short term, and low duration kind of products. These are mainly used for, more of parking solution that you use your money that is lying in your traditional account. You can use it to park these money to get better returns as compared to those traditional deposits. Then there are other categories, as I said, medium duration, short duration, long duration fund. So it is, I mean, for an investor who has a time horizon of 3 to 5 years to 7 years, or maybe a perpetual, he wants to stay invested for a retirement sum. I mean, the asset allocation, I'm sure many of the investors there in our webinar, they understand what asset allocation is. So obviously, as compared, depending on your risk appetite, depending on your liabilities that you have in future and what you want to achieve, there is an asset allocation pattern. So asset allocation will include your maybe exposure to equities, to commodities, to gold, to fixed income. So fixed income is also a very important part. So we have actually for past couple of years, we have seen decent kind of money that we are getting in these medium duration, short duration, that people want to stay invested for a very long period of time, maybe 3 years, 5 years, 7 years. So we have a category like corporate bond fund, Axis corporate bond fund, Axis short term fund, Axis strategic bond fund, or something like for someone who wants to retire and allocate money to debt fixed income schemes. So we have Axis long duration fund that invests in a 30-year security. So broadly, you keep on investing in those funds, and the best part that I told you, the tax liability will come to you once you redeem the money. Till that time, your tax. I mean, it's kind of a I won't say tax free, but you can defer the tax till the time you redeem the money. So you can keep on building your corpus, accumulating, and then you can use debt mutual fund schemes as an asset allocation in long duration fund to get that decent amount of, it's a great substitute and balancing factor when you compare it with an equity scheme. So it's a very good balancing factor that you require in your portfolio, along with equity and commodities also.
So Aditya, there's a very nice question which I'm glad has come up, that why not consider arbitrage funds instead of the traditional debt funds?
Very good question, actually. I mean, this is a question that we actually get many times. So just try to understand what happens in arbitrage. So arbitrage fund is what it tries to capture arbitrage in the cash market and the future market. So the most liquid future market, what you have is a 1 month, 1 month futures market. So what happens is the fund manager will buy something in cash and short a future against it 1 month hence future. So what happens? The lock-in rate is only for a month. So next expiry cycle that you say, the next expiry cycle, the reinvestment risk is something that the investor run on. So for example, this month you lock in the rates at 7%. There is a high possibility that next month your reinvestment rate would be low to a 6%, a 7% also. So you run a reinvestment rate because it's a 1 month product. If you compare it with the ultra short term or low duration fund, what happens is because we run a bit of duration. It's not exactly 1 month product. We run a duration closer to, it might range from a 4 month to a 6 month, 9 month kind of a duration. So what happens is whenever there is a duration gain, so just understand we are at the peak of rate hiking cycle. So we see the rates going down from here. Though obviously the rate cuts are not expected very immediately, but whenever the rate cut happens, maybe 3 months, 4 months, 6 months down the line, so there is a slight bit of duration benefit that investors get in these kind of ultra short-term, low-duration money market funds. And arbitrage fund, obviously, again, if your asset liability is more, your liability is more to a 1 month maturity, 2 month maturity, the investor can definitely invest in these kind of arbitrage funds. But if you have a time horizon of 3 to 6 months, now these are the beautiful products to invest in. So again, uh, your liability when it comes to, depending on that time horizon that you can give to the fund. On that, you can decide where to invest.
Okay. Aditya, one of the last questions being that how exactly can I know what is the expense ratio of the funds? And if I park for just 1 month, am I still charged the expense ratio for the entire year?
So, see, the expense ratio is very clearly available on our websites. You can visit the website, go to the particular fund category. You will see all the, what we call as quants, what the fund maturity is, what the fund composition is, what kind of ITMs it is, what is the duration I'm running, and what is the expense that I'm running in the particular fund. So as I told you, the beauty of the fund is you invest 5,000 rupees or you invest 5 crore rupees, every investor is going to get the same returns. So as far as your question goes, Tanvi, it is the expense ratio that you see. It is not that you stay for 1 month and then you are charged for the entire 1 year. No, that is not the case. Whatever time period you stay invested in that fund, for that time period, the expense will be charged, and the net returns that is reflected by our NAVs that will be given to you whenever you redeem the money. So whatever time you stay, the returns will be proportionate. The expense charge would be proportionate to that only. No additional return, no additional expense would be charged to you for staying for a short period of time in any of our funds.
Okay, and another question, Aditya Peak, that is this the right time to invest in gilt funds?
Again, a duration part of the question. Again, I repeat, we are at the fag end of the rate hike cycle. We might see a rate cutting cycle, not immediately, but 3-6 months down the line. We have many positive triggers as far as duration funds are concerned. First being our inclusion in JP Morgan Bond Index Fund. Second being inflation is being under control. Our fiscal deficit is under control. What RBI, basically what the ministry has laid down the fiscal glide path, we are following that fiscal glide path. The money that FPI money that we are getting in that fixed income markets is another inflow that we are running. Again, since we are included in JP Morgan Index, obviously there are expectations that there are many other passive index funds that are evaluating including India into their indexes. So there are actually many triggers. So for anyone who wants to invest in gilt funds, it's a very beautiful time. Only thing is you would have to have a bit longer period of time horizon, maybe 3 to 4 years to get the best returns by investing money in debt mutual funds or any time of, basically any duration fund. If you have a time horizon of 3 to 4 years, you pick any duration fund, gilt fund, short-term corporate bond fund. It's a beautiful time to invest. If Tanvi would have asked me this question in April 22, I won't have answers actually where to invest at 4% and operating rate, locking it for 3 years. I wouldn't have been confident, but from 4% to closer to 675 after 275 basis point of rate hikes. I'll be more than happy if investors with a time horizon of maybe 3-4 years investing in any of the duration funds. More than happy to see investors investing money in those categories.
Thank you so much, Aditya, for the wonderful interaction. And I hope that our audience has got some insight on what exactly are debt funds. Just one last question, which I will answer, is this an NFO, and where can I check the details? So just to inform, this is not an NFO. These schemes are very much a part of our debt fund portfolio at Axis. And you can check all the details on our website, www.axismf.com. So please do not hesitate to go around, question on the website as well, and we hope you find this session interactive and informative. Thank you so much. Thanks, Aditya.
Sure. Thank you so much, everyone. Pleasure talking to you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.